Without any further ado, let me introduce you to Corey Masala as he brings the group up on stage. We've gotten to know Corey over the years. He's been a valued member of our faculty. Katz Sapper and Miller, as I'm sure you know, is a consulting and accounting firm. Corey is leading the New York office, and he's a partner in the firm's transaction services group. He brings more than 25 years of experience to his engagements, providing business consulting, audit, tax services for clients across a broad range of industries, including private equity, technology, which, as we've learned today, is all pervasive and, of course, impacting every sector, family offices, alternative investors, financial services, real estate, healthcare, transportation, and manufacturing. Corey's responsible for over 350 transactions, and we've certainly come to rely on him at the M&A Advisor as a guiding resource for what to talk about and how to talk about it, and I can't think of anybody better to lead the dialogue about what's out in front. Corey.
All right. Well, thank you, David. It's a pleasure to be here today, and I'm honored to be joined by this outstanding panel of M&A professionals. Advance the slide. Wherever my clicker is. There you go. All right. So let's start by having our panel introduce themselves, telling us a little bit about their firm and why their clients choose to work with them. So, Jason.
Good morning, everyone. My name is Jason Barg. I'm a principal with Lovell Minnick Partners. We're a middle market private equity firm. We're based in Philadelphia and have an office here in New York and an office in Los Angeles. We invest in financial service and business service firms. We have a bias towards growth companies. Most of our capital is used for buyouts, but we're sort of growth investors at heart. We tend to effectively partner with management teams to deploy growth strategies in our sector.
Jolene.
Hi, my name is Jolene Caruso. I am CEO and founder of the Alberline Group. We started the company 7 years ago. It is backed by family offices, one prominent family in China. And we have two parts of our business. One part is an incubator for bankers. So we actually have 6 investment boutique banking teams working on our shared infrastructure platform on one side of the house. And on the other side, we have a merchant banking fund that actually does direct deals that are sourced by our bankers or other family office clients. And we've built a track record over the past 5 years of investing in direct deals in SPVs. So these are the two sides of our business.
Thank you. Doug?
Good morning. Doug Hendrickson. I'm co-founder of Midcap Advisors. We're a merchant bank based here in New York with offices in Boston, recently Jacksonville, Florida, Connecticut, New Jersey. We focus on a few sectors, financial services being a prominent sector of ours, as well as fintech, manufacturing, and other business service type companies. We have a small fund where we invest in early stage companies. And we've had that for about 6 years now. We have 8 holdings in there.
John?
I'm John Castle with Branford Castle. Branford Castle is a 30-year-old lower middle market investment firm. We focus on making investments in companies with under $15 million in EBITDA. We are a generalist firm, but typically focus on companies that are in the consumer goods and services space, the transportation and logistics space, and manufacturing space. Our principals have closed hundreds of private market transactions. We're especially proud of the relationships that we're able to develop with our management teams. 2 of our last 3 portfolio company CEOs have made somewhere between 30 to 45 times their rollover investment.
All right. Well, thank you all for the intros. Let me give you the first question. So far in 2017, the number of M&A deals has decreased by 11% from the prior year. And there was a 20% decrease in deals between quarter 2 and quarter 3 of this year. Is this similar to what you have experienced? So I'll keep it in order and then I'll mix it up. So Jason, hit it first.
It's not similar to what we've experienced. We've completed 7 new platform deals this year that far exceeds what we did last year. We've also completed, at least in the past 2 years, nearly 24 bolt-on acquisitions for our portfolio companies. So we're seeing a fair amount of flow. I think, within, I probably don't need to say it to this group, but within kind of the M&A environment, it's, everything's kind of local. It's like real estate. And, for within our sector, within financial services and business services, we see a lot of appetite for M&A, and certainly haven't seen a decline relative to last year.
And Jolene?
Same with us. At the Alberline Group, we have a number of sector-based banking teams, and similar to you, the financial services FIG team, who focus on insurance and asset management firms, have been quite busy this year doing roll-ups of insurance brokerages and also registered investment advisors, where we're seeing a tremendous amount of consolidation in the industry. I think the other part that has been most interesting to us is because we have a whole family office side of our business and have deep relationships with global family offices, we're seeing tremendous amount of deal flow as these companies transition from the first generation down to other generations and think about either selling or morphing their firms in a different way just because of that generational shift. So we've been quite busy.
And Doug?
Yeah, I would second what Jason and Jolene just said. And these large industry metrics confuse me a little bit, because I did see in the M&A fact sheet that it said that there's been a record number of transactions done since Donald Trump got elected. So 1 month can really spike volume and closings. But anyway, in the lower middle market where we work, we're probably going to have a record year. We'll close maybe 12, 14 transactions this year, which is a lot for us. And we'll make three or four minority investments. So we're, in the financial services sector, which is, our strength, which is also Jason's. It's a very, volatile, heavily consolidating sector. So we're seeing a lot of activity.
And Don?
Yeah, I guess I'm going to just sit here and agree with everything that's been said. It'll likely end up a record year for Branford Castle. We closed our most recent fund about a year ago. It's likely that by the end of this year, we'll have 4 platform portfolio companies in the portfolio. 4 deals like that in the first 15 months of a fund is not bad for us. And so, look, I read the same industry statistics, but it sounds like everyone here is pretty active in terms of what we're doing.
Yeah, so I think as we progress, we'll kind of address this question about, the statistics say one thing, but yet our panel's saying another thing, that they've had robust years. So really, what's going on? So as we lead through this, maybe we'll get to an answer. So, all right, so prior to this event, my firm, Sapper & Miller, launched a survey in conjunction with M&A Advisor regarding M&A trends over the past year and the outlook for the coming year. The survey was sent to 100,000 experienced M&A professionals from a variety of backgrounds, including executives, consultants, advisors, lenders, attorneys, investment bankers, and other service providers. I'd like to share the results of that survey with you and talk through some of these items with our panelists. The first survey question related to the greatest challenges buyers had in 2017. Which of the following variables in your experience have presented the greatest challenges to buyers in 2017? As you can see, at 73%, seller valuation expectations dwarfed all the other options. Compared to the results of last year's survey, which is not up there, but I'm sharing with you, respondents rated many of these options as lower percentages, showing the true magnitude and challenge of seller valuation expectations upon buyers this year. This year's survey shows that quality of IT strategy and management is becoming an increasing challenge, along with cost of integration and operation support. This likely could be due to the increase in add-ons to platform companies this year. So let me ask the panelists about this. During 2017, what did you experience in terms of sourcing deals, entering into LOIs, and getting them to closing? What were the successes and challenges you encountered? John, you want to grab this one?
Well, sure. I think as a firm, we've been up in terms of the number of deals that have come in. We're down slightly in terms of submitting expressions of interest and letters of intent, but we're up in terms of overall deal close. So it's somewhat of a mixed bag. At the end of the day, I think what you're really looking for is to close deals that you like. So net, it's a success. But look, the thing that I don't think is maybe adequately demonstrated by the graph here is the impact of the new administration on deal activity. Look, I mean, you're talking to panelists. I think that it sounds like we're all getting deals done, but it doesn't surprise me at all that there is a decline in deal activity. And this is not a political statement, it's just simply a factual one. The administration has come in and they are trying to tackle what they would consider to be big issues that our country faces. And they are trying to attack it or tackle these issues in big ways. You're talking about issues like Obamacare, rewriting our international trade agreements, tax overhauls and reform. I mean, these are big issues. And there are a lot of companies that are going to be affected by these, by what the administration is doing. Ultimately, this is, again, not a political statement, it's just a fact. And it undoubtedly creates a significant or a not insignificant amount of uncertainty for a lot of different companies that you're either looking at or other people might be looking at. So, getting back to the statement that deal activity is down, that doesn't surprise me, and I would guess that some of the political environment is the reason why we're seeing some of that.
Good points. Doug?
I would say, the challenges with sourcing transactions is seller expectation in terms of multiples. I work in the lower middle market, as I mentioned earlier, and I think a lot of our clients, read in the press that multiples are double-digit multiples, and they, when I tell them, I think their company's valued at a 6 or a 7 multiple, they look at me, they cock their head and say, "You got to be kidding me." So there's that challenge that I have to face on an ongoing basis, and then. In terms of difficulty negotiating LOIs today, we do a lot of add-ons with private equity firms, and there's always a debate in terms of negotiating, the value of the synergies when we're doing an add-on. We're trying our very best to get, if the multiple is going to be a 6 or a 7, we're trying our very best to agree to a pro forma with our buyer that's fair and reasonable. So that's an ongoing challenge of ours, one of them.
Okay. Colleen?
So we've had to be incredibly creative in terms of the business model of the company, whereas just a few years ago there was not a lot of competition in the lower middle market. We're similar to you, Doug. We've actually seen, because of all the dry powder, upwards of $1 trillion of PE dry powder, that PE firms have gone down market, and there definitely is more competition for the deals. How we've sort of mitigated that challenge is really developing for the last 5 years an incredibly strong global family office network. And the interesting thing about that client base is we have found that the closure rate is a lot higher, because when you're working with a family and you have that long-term relationship with them, and who we have on board working on some of these relationships, the closure rate is actually higher when you have that kind of a relationship and you could bring family offices together. We also see family offices now hiring investment bankers and building their own ecosystems where they can disintermediate all the private equity firms and actually sell family to family. So we as a firm have actually tried to capitalize on that trend and get in the way as a financial advisor between these two families and working to close deals. So it's been a little bit of a different approach, which has led to not seeing a decline broadly in the business this year. Our business is actually growing year over year.
Now, let's come back to it, because in terms of the time frame, since you're working a lot with family offices and putting this all together, there may be a differ in the expectations and indications and the time horizons that may be of value.
For sure.
Jason.
I think challenges probably echo what my fellow panelists have talked about. It's really valuation expectations. A lot of that in our business driven by sort of more competition in the market. Definitely see, larger private equity firms going down market and pushing on valuation expectations. I also more routinely are seeing in sort of bolt-on acquisitions, sellers talking about the synergies that the buyer is going to receive and why the seller should be compensated for those synergies as opposed to the as opposed to the buyer. Certainly all of this creates a dynamic where valuation gets, the expectations at least are getting pushed up. The flip side of that is I think what we're seeing is a fair amount of overall confidence out there, and that's making, at least within our sector, it's sort of loosening up some companies that had been hesitant to transact. And what we're seeing is a lot of companies wanting to sort of double down on growth strategies, and oftentimes that requires finding a financing source like us, other private equity firms, to help deploy those growth strategies, and that's very compelling to business owners and can create transaction opportunities for us.
Would you, and just remind everybody, you're focused on the service industries, but would you also say that the aging population has also played anything into this year, or not at all?
I think that's probably a good point. A lot of the businesses that we invest in or that we acquire are businesses that were founder-owned for many years, and there's some impetus to gain liquidity. I think in the services business and financial services, we tend to, Doug could comment on this as well, we tend to want the sellers to hang around. We don't come in there and sort of take out CEOs because they're human capital driven businesses. And I'm sure CEOs and founders look in the mirror and say they realize that that's the dynamic out there, and they want to capitalize on opportunities to sell.
Doug, I'm going to give this to you. I'm going to ask the question, but then if you want to address that and then answer this question too. You get double whamming you.
Okay.
All right? So I'm going to ask the panelists, what were some of the inflection points that occurred that prompted sellers to choose you? And what was the deal structure? And was the deal structure ever a variable that helped? So Doug, maybe you can interrelate that into, so.
Well, clearly, Jason's spot on. When you're selling a company that's human capital intensive, like an insurance services business, you've basically, your seller is not just the primary owner of the business, it's all the producers who control the clientele of the business. And so you end up really negotiating personal goodwill agreements and all sorts of compensation agreements with the whole production staff. So it's pretty complicated, and I know Jason's probably done it many, many times. This year, an inflection point on this particular transaction, we were brought in after a transaction was failed with a PEO, and I'd say that was a process that did not have a banker, and they ran into a lot of complications with the buyer. So that was just an example of where we would be brought in, in a situation.
Excellent. Julie?
I would say on the inflection points, as we were developing this broad family office network, we actually leveraged the sector expertise of our bankers. And once we started capitalizing on that and letting our families know that we had renewable energy or healthcare, life sciences, or deep real estate or FIG, the families were able to rely on the sector bankers for the industry expertise and us for the structuring. It's interesting, our firm, my partner and I who started the firm, are not bankers. We were never in investment banking. We were on the investment side of the business. And I think to your question, Corey, on the structuring, we both know how to structure equity and debt deals. And I think in partnership with our bankers, there's been a great combination of using those structuring and investment skills alongside the banking skills, which has led to a higher closure rate and just a more cohesive ability to service these privately held middle market companies.
All right. John?
Look, I think it really depends on, each transaction presents different sets of circumstances. And as I think through the different transactions that we've closed over the course of the last year, there have been circumstances where having an operating partner in a specific sector that we could slot into being a CEO was crucial in terms of getting one deal done. Having significant industry expertise in another sector was helpful to get a second deal done. I mean, we could go down the line here, but look, I think that the thing that we aspire to bring to the market is different sets of skills for different circumstances. In the lower end of the middle market, actually, sometimes the mere fact that you have a fund can be a differentiating characteristic versus a lot of independent sponsors who do not have a fund. I mean, just having the capital can be differentiating. So, look, there's a lot of different ways to get into the driver's seat for a deal.
Go ahead, Jason. I'm going to come back to you for a second.
I'd say, you know, I'm not sure that structuring's really been an impetus for us. That being said, I think generally speaking in our transactions, you know, going back to that kind of comment about founders, it's a second bite at the apple. It's, you know, the ability to take some chips off the table while still retaining an equity ownership and getting a second bite down the road. And with us, and I'm sure any private equity firm coming in, there is this sort of acceleration of growth. There's a great opportunity with a change in ownership to come in and invest in growth and drive the business forward. I worked on, as an example, a deal with Corey actually, where the seller was a great company, founder family controlled, and the company thought there was an acquisition opportunity, but never had the capital or sort of the inclination to pursue that. We invested in the company 2 years ago, and we've completed almost 10 acquisitions in a short amount of time. That's the sort of opportunity that a founder can see and would encourage pursuing a transaction.
Yeah, that one was a home run. They just needed sophistication and the ability for somebody to help them how to close deals. So, the second question in our survey asked survey respondents to rank how influential certain opportunities were to influencing buyers in 2017. Building a company for increased revenues and profits is on top, with creating a platform business that will command higher sales multiples next. Again, comparing to last year's survey, higher ROIs dropped off. This could be the result of more focus in 2017 on building platforms and an increased focus on quality add-ons. Investing in high growth sectors also dropped from last year. Now we have a question for the audience. So if you're going to do the survey, now's the time. Will the trend toward doing add-on deals instead of platform acquisitions continue into 2018? It's a yes or no. So I think it shows up as it progresses. As you're marking your answers, I'll share with you that in 2017, add-ons were 64% of all U.S. buyouts, which is obviously substantial. And as Jason just alluded to, you just heard about 10 add-ons on one company in 2 years. So I'm going to ask John, can you give some insight, any insight you'd like to share on whether the trend of increased volume of add-on deals will continue, and for anybody else wants to join in?
Well, look, I think as a general rule, if you have a great platform company and there are bolt-on opportunities that you can add to that company, I think that it is a great way to grow. We have a few of these companies that when we acquired them, we thought to ourselves, look, what does the bolt-on acquisition universe look like? And there were a substantive number of potential transactions, and it was one of the ways that we would originally get involved or with a company, with a platform company. We've had a lot of success with acquiring bolt-ons to go on top of our platforms, and I would expect that to continue in the future. I mean, it's something that you have to be good at. There are plenty of integration issues, and if you don't effect the right transaction or don't put together a transition plan, you can run into some difficulties, but it's been a pretty good and effective technique for us.
And Jason, would you say that if you had your choice with the resources you have, would you choose column A add-ons or to go out and seek out a platform?
Well, I mean, we are
That's a leading question.
At the end of the day, you know, all of us in the private equity business have to do platform deals.
Right.
So I don't think it's, at least for us, it's not sort of an or.
Yeah.
It's kind of an and you know, bolt-ons are very attractive for all the reasons that John mentioned. I think we're gonna keep doing them, but they can't really come at the expense of also pursuing platform opportunities.
All right, great. Anybody else want to lend before I read the questions? So what's the, what do we have in terms of the survey? Yikes. Everybody can read that, 93%. The trend will be continuing into 2018. Speaking of trends, the next question asks, which trends deal makers and advisors are encountering more frequently as we approach 2018? Not surprisingly, increasing business valuations reflecting higher EBITDA multiples ranked highest, with increased competition sourcing deals and increased competition from strategics not far behind. When you compare that to last year, decreasing debt multiples and industry consolidations dropped. The decrease in industry consolidations could be due to a loss of opportunities as a result of prior gangbuster years or due to political uncertainty. So again, one more survey question. The median EBITDA multiple for 2017 was 10.5 times. Will multiples in 2018 increase, decrease, or remain the same? And one last tidbit on a fact. While the audience is voting, I'll share with you that during 2017, the private equity inventory acquired and still held over 5 years has reached 38%. This is the highest proportion recorded by PitchBook since the data set has been kept. Is there a current trend that PE firms are holding portfolio companies longer? Jolene, I'll give you a shot, but go to it on the, either you want to hit it a little bit from what you're seeing on the PE, but also on the family office, and comes back to my question about the hold on the family offices and
The
how they could
timing
be.
on the hold.
Yeah.
I mean, this presents probably our biggest challenge in terms of our business model, because when family offices do acquire companies, there's absolutely no urgency to sell them. In fact, they want to be long-term generational holders. So to have the business model that we have requires consistently developing more and more relationships with families, because there is no pressing exit. They don't have to sell, they don't have to buy, they don't have to write a check. It's very, very different than working in, obviously, the PE realm.
Jason?
Well, I would say that in terms of the holding long for longer periods of time, I'm not really seeing that in private equity. I think that we're seeing sort of a consistent flow of activity. You could make the argument that if the surveys, well, whether the survey's right or not, we know that multiples are up here, and that encourages some form of liquidation. So I'm not seeing anything to sort of say hold times are being extended.
And John?
Look, I think in some respects, at least for private equity firms, you have to assess where you are in the cycle. And if you have a few businesses that you are concerned might be slightly cyclical, you might exit them sooner rather than later if you think we're coming to the end of a cyclical run. I mean, what have we been up, last 8-9 years consecutively? Some people feel that's a pretty long run. But aside from, I think, assessing that cyclicality, I'm not sure where that goes.
Okay. The results of the survey? All righty. So the median's 10.5 doesn't mean each one of you are in that spectrum, but it's basically saying everybody believes the whatever the multiples are today is going to remain the same going into 18. All right, one other issue our survey addressed was cross-border M&A transactions. As you can see, Asia is by far the region seeing the most outbound U.S. direct foreign investment. I'm going to move on to this one. So now to the hottest industry sectors for 2018. Our survey showed that technology, healthcare, life sciences, and financial services are among the hottest industry sectors. Compared to last year, logistics is hotter, manufacturing is slightly warmer than last year, and wholesale improved from last year. Food and retail both sank in the rankings. So let me ask the panelists, what are you experiencing as the hottest industry sectors? Doug, I know you're focused, but I'd like to hear your thoughts.
Well, clearly financial services, I think, and curious what Jason thinks, but we see consolidation continuing for another year or so. It's pretty much in the insurance services space, which we do a lot of transactions. It's pretty much controlled by private equity today, and that trend is just going to continue. Technology as well. We just started a fintech group in Florida. We're very bullish on fintech and insurtech, so we see a good runway for those sectors.
John?
We have a generalist bent to us, so we see lots of different types of businesses and lots of different industries. I mean, look, over the course of my 15 years in private equity, there's always been a constant flow of oil-field services businesses that are coming to market, and then the last few years, due to the uncertainty in the healthcare markets, there's been a lot of healthcare that has showed up on our desk. But look, we look for those types of companies that are niches upon niches, and they can show up from all different sorts of industries. So I don't think what we do corresponds necessarily to the check you're putting up there.
Right, you're looking for the deal.
There's opportunities in lots of different areas, and they present themselves in ways that somewhat don't correspond to the nice graph of which industries are hot.
Put them in a peg.
Yeah.
Jolene?
We're deeply sector focused, and while our FIG group has been very active this year, going forward, the new engagements we've gotten recently have actually been in the renewable energy space. We have an impact investing side of the business, and in the renewables, we're seeing traditional manufacturing companies acquire clean tech assets, manufacturing companies acquiring, sustainable materials or flooring. So I think this whole impact trend will continue. Also, we're busy on the healthcare side. We have an active life sciences practice, and where we've actually found a niche is to do licensing deals. We have an Asian family that actually, we just closed a deal to secure the licensing rights in China on a pharmaceutical, life science, cancer therapeutics company. So we see opportunities in the healthcare and energy areas increasing for us in 2018.
So innovations. Sounds like you're all in innovations.
Yeah. We don't do any technology, but we're innovating in more of the impact sustainable area.
Jason?
It's a tough question because there's probably, if you think about each one of these bubbles, there's probably 25 bubbles behind it, and they're on one side or the other of the axis here. Because we focus on really financial services, there's certainly elements of that sector that are hot, and there's certainly elements of that sector that are sort of less interesting right now. I think the technology-enabled businesses are very interesting. People are more and more kind of focused, at least in our sector, focused on the margin of their companies and utilizing technology in ways to increase their margin, increase their efficiency, enhance their client experience. So that's an area of real interest to us within financial services.
Well, that kind of leads to, so now it's another, advance the slide, another polling question. Will private equity investment in the tech sector increase, remain the same, or decrease in 2018? So, as you're answering, I'd add that tech comprised nearly 20% of deal flow through the third quarter of 2017. The answer to this question should be interesting because tech investments are largely influenced by risk, which may also be impacted by government policies and steep valuations. I didn't list this question, but I'm going to ask it anyhow. So, in everything you're investing these days, tech seems to somehow be coming in, and it's a blurred line, because Doug, you said fintech, health tech, but it's where do you distinguish between the two? So, and John, I see your head moving. So go, you want to just address when you're going in and buying a company now, right? You've got to evaluate the technology and where it's going to go. How have the dynamics changed? In the last few years, on every time you want to do a deal, from the past? How much of a focus has it started to become? Yeah.
Well, look, I think you have to break down in terms of two categories, and I think you're highlighting this: technology-enabled businesses versus other businesses that you'd consider to be technology-focused. It's almost unavoidable these days. You have to. Well, actually, let me take a step back. Lots of businesses these days have become technologically enabled, whether it's through a software platform that they're using, that they've created for themselves to help their businesses. There are very few businesses that now come in where you would say you don't have to have some level of capability in the technological area. So that's technology enabled. In some respects, when you're talking about pure technology, you think about businesses like software businesses. Software businesses are not businesses that 10 years ago we would have considered. I think we would consider them now, depending on the industry. I think that this has to do with there's more evidence of the life cycle of software businesses today than there were X number of years ago, and people have become more comfortable with them.
Doug? I mean, Jason, you look like your head's moving.
I was just kind of thinking along the same lines. Within financial services, we don't like the word fintech because we sort of think that that's not really a sector, that every company within financial services needs to have some sort of technology initiative and utilize technology in some way. That being said, it seems like when we look at opportunities, investment bankers are increasingly finding ways to call any business a technology business, which is
Higher
sexier
multiples.
and higher multiples. Yeah.
So, Doug, you want to just you queued up for this one?
Well, I agree with them. We're not a technology firm. We're a generalist merchant banking firm, an M&A firm. But that said, we invested in an ed tech business, and we've got this new group that's going to focus on insurtech and fintech, which I think is just sort of a narrow sector within technology. So I think in 2018, I think the trend's going to continue in that sector. At least I hope so.
Yeah, I think technology is disrupting every single industry, and we're trying to figure out not how to engage, but how to take the traditional industries that we have, like our renewable energy business, and figure out ways that we can capitalize on technology's change and think a couple of steps ahead. The type of deals we want to be out there digging up and showing our principal investors on the merchant banking side. But clearly, not having technology knowledge or background today will kill you because it's changing every single industry.
And it's moving fast. All right, the polling answer? It should not be a surprise. And it's not. All right, so the next question was, what were the factors that had the greatest effect on U.S. M&A growth? What will be the greatest effect on U.S. M&A growth in 2018? And as you can see, you've got the four that we chose that were the largest. But we'd like to ask the audience to weigh in on this and select which one they think will be most influential. What factors do you believe could have the greatest effect on U.S. M&A growth? Tax reform? Increasing U.S. interest rates, tax reform, changing political climate, expectations for higher multiples. And while that survey is going on, here's the crystal ball question. What's your expectations for 2018? And where do you see things going in the coming year? John.
Well, look, I think if we're referring to these items on the list here, look, I mean, all of them will have an impact. I mean, it's very difficult to know how it all shakes out. When you ask about interest rates, the first question is, well, how high will they rise? Tax reform, well, how large will the change be? Changing political climate, and actually, I consider changing political climate and tax reform to somewhat be similar or related issues. Expectations for high multiples, sure. Look, from my own standpoint, we have to get up every day and we have to make solid investments. And we're going to continue to do that and find ways to make successful investments with a value orientation, no matter what the set of circumstances are. I think that a really good private equity firm sticks to their knitting in terms of who they are, but is constantly looking for new and interesting ways of or areas to make investments, ones that where potentially the herd is not piling into or not as affected by some of these issues, and that's what we will continue to do.
Jolie?
I mean, I look at this list, and there's a couple of things on here that frighten me more than this. We look at U.S. interest rates. We have a Fed chief that will probably follow Yellen's policy, and rates may stay stable. I can't predict rates. But what's not on here is just the global instability that we have right now. We have Brexit. We could be at a potential war. And to me, those things, obviously, you can't factor in. But I'm surprised that global stability is not a major factor up there on that list. One comment. Second comment is I also think that we do have to pay attention to what is happening with the family office. Again, I have a myopic view of that, but what is happening as family offices aggregate capital, really disintermediate private equity funds, really try to drive change among their massive capital that they have accumulated, and how they're really going to change the face of financial services, because I do think that this is going to be a very big trend.
Jason, perfect time to comment on all of that.
Well, hopefully the family offices aren't stealing our jobs, but
Don't count on that.
nevertheless,
I like the smiles on both of your faces.
I think the biggest thing in our minds that will affect the deal environment overall is where we are in the cycle, and a lot of these are sort of end up being inputs or outputs to where we are in the cycle. I think from where we sit, we don't see necessarily huge structural imbalances that occurred sort of at the end of the last kind of bull market run, but there's certainly instability globally that could have an impact on the cycle, and then there's just the timing. We are long into a cycle that's in an up market that's been sort of a weaker up market, but nevertheless we're sort of long in it, and ultimately when things slow down, deal activity will slow down, regardless of, I think, of any of these inputs.
Doug?
I think you could probably add to this list a few other things. One being there's probably more dry powder out there than.
That was my next one, but good.
Okay.
Cue me up.
That's got to be deployed. There's more credit funds out there, so that means hopefully there's some credit availability. So we think 2018 will probably be a pretty strong year, and don't know about 19 or 20, but 18, our visibility on 18, we feel pretty good.
So the survey results, is he there? I see no head. So, all right, we'll go forward. I'm going to add 2 questions to the audience if anybody wants to ask.
Question for Jolene, I suppose. You mentioned a bit more on the change from larger deals to smaller deals, but I guess from a family office perspective, as an LP, the fact that mega funds are actually going into more credit.
I can't hear him.
The fact that mega funds are going into more credit and mezzanine type situations, is that reflective of either risk mitigation, or is that just other ways of addressing institutional investor interests? The fact that mega funds are getting more into credit, what's your theory on that?
On
Mega
what?
funds are
Mega
getting
funds getting into credit.
more credit.
Like the hedge fund world's getting more into the credit and offering that mezzanine financing? Is that what you're...
No, it's more on when you see KKR and Carlyle and the like having debt instruments. What's the rationale on that from your perspective?
Well, I know I can speak from the family office perspective. What those funds are trying to do today is actually try to attract that client base, and they're repackaging a lot of the funds that they've sold to more of the sovereign wealth and institutional clients to family offices. But I will tell you, it's a hard sell, because when the family offices look at the fees and look at what they get the joke that they're just repackaging existing funds. This is the feedback that we hear.
All right, last question. Go ahead, right here.
The question is from Mr. Castle. Mr. Castle, you mentioned earlier that your firm is invested in transportation business. The question I have is, have you taken any position in the shipping industry, or you prefer surface transportation instead, given the fact that the United States is growing in manufacturing and all that, and given the fact of the turmoil in Asia right now, what's your idea of the shipping industry, and where do you think it's headed the next 5 years? Where do you think, what's the direction of the shipping industry?
What is your idea, what do you think about the shipping industry going forward?
Our organization has a significant amount of shipping expertise. I am not a shipping expert. The answer to your question is that we have a sister organization by the name of Castle Harlan. Branford Castle has been a more substantive investor on the ground transportation and logistics industry. Castle Harlan has been more significantly on the shipping side of the world. Happy to discuss that further with you, but I would want to bring somebody into the conversation.
All right, so quickly in summary, so EBITDA multiples remain the same going into 18. We're definitely subject to a lot of different variables politically that could affect things in a big way next year. The surveys show tax reform. Add-on platforms will continue next year, and as you can tell from the panel, depending upon your industry, you're robust. Some are down, some are up, but the industries that we have on our panel, they're doing very well. And thank you all, and let's thank our panel.